Thanks for clicking. My name is Mark Mitchell, I'm a mortgage broker here in London, Ontario. With U.S. inflation hitting a 40-year high of 7.5%,
Holy
all eyes have been on Stats Canada, which was set to release Canada's inflation rate this morning. After many predictions that the inflation rate would hold steady around that 4.8% that we saw last month, we actually came in at a 31-year high of 5.1%. With the U.S. Federal Reserve set to raise interest rates in its upcoming meeting, with many calling for rapid rate hikes to the tune of 50 basis points, that would be 0.5%, the Bank of Canada raising its interest rates on March 2nd is all but assured. Given the rise in variable mortgages that we've seen over the past couple years, the rise in the use of home equity lines of credit, and the massive increase in Canadian consumer and government debt, a rise in interest rates is a big concern for homebuyers, homeowners, consumers, the government, anybody holding any debt.
Every one of you.
So what I want to do today is go over the inflation rate released by Stats Canada, then go over some of the interest rate predictions being made by the big banks and by the markets. And then we'll go over what those interest rate hikes could do to the average mortgage payment in Canada. And then we'll go over some tips for how to prepare yourself in the face of these upcoming rate hikes. We are expecting to have the Bank of Canada interest rate announcement come out March 2nd, and given the skyrocketing inflation that we're seeing today, I'm expecting we'll have more updates out in the next couple weeks as well. Click like and subscribe if you want to get those updates, but for now, let's get into this inflation rate. So as we said, Canada hit a 31-year high inflation rate of 5.1% in the month of January.
I think we're in a lot of trouble.
Yeah, I mean, definitely not great. We're moving in the direction of the U.S., which, as we said, is at a 40-year high of 7.5%. So Canada last month was at 4.8%. Now we're at 5.1%. Definitely not moving in the right direction. Further, whether you agree with them or not, the blockades from the U.S., which has slowed down a large amount of goods from getting into this country, are only more likely to exacerbate the inflation problem, as anytime there is a shortage of goods, prices go up. Add to that is the potential for $100 oil, oil prices possibly getting to $115, and we also have the Russia-Ukraine crisis, which, although it's looking better, still maintains the possibility of driving up prices.
what a time to be alive.
So, all else being equal, rates are definitely going up. Look for them to come out on March 2nd, and we do have multiple predictions in for how high those prices will be going up. BMO, for its part, has predicted that rates will be going up 100 basis points over the next year. That's 1%. Scotiabank, which, if you'll remember, had called for 8 rate hikes, 200 basis points increase by the end of 2023, is now saying that we'll probably be looking at 175 basis points, 1.75%, by the end of 2022. Markets are pricing in about 6 rate hikes, or 150 basis points, 1.5%, over the next year as well. So it does look between BMO, Scotia, and the markets that will be looking at between 1 and 1.75%, 175 basis points rate increases over the next year, set to start on March 2nd. In any event, these rate hikes are going to be relatively significant. And I say relatively because the interest rates are still below the rate of inflation, which by definition are real negative interest rates. This is still a loose monetary policy, an accommodative monetary policy, at a time where inflation is a record 31-year high.
The whole world's off its rocker.
Nonetheless, a rise in interest rates will have a real effect on mortgage payments going forward. A recent Globe study showed that a mortgage with a variable rate on a $720K house with 10% down over 25 years would see its payment rise $339 after a 1% increase. This is a time when many are calling for a 1.5 to 2% increase. So if you take the average house in Canada, which is around $770K, those people that are currently holding variable rates could be looking at an extra $340 a month just with a 1% increase. Keep in mind as well that the 2% increase that even Scotia is calling for is just in 2022. We still haven't talked about 2023, 2024, and going forward. When interest rates started to rise as of 1988, they didn't stop until 1990, at which time prime was at 14.75. And prime right now is at 2.45. And keep in mind, when prime was at 14.75 in 1990, inflation was only at 4.03%.
That we live in amazing times.
With all of that said, if you do have a variable rate and you do think that it's time to lock in, Nobody can, despite all the expert predictions, despite Scotiabank, BMO, the markets, nobody can really predict where interest rates are going to be the next year, 2, 3 years.
Nobody knows anything, really.
With that said, if you take a look at your budget and you see that a rise in interest rates is going to stretch that budget a little thin, then it might definitely be time to look at locking in your variable rate. In order to do that, you just give your mortgage lender a call, be it a bank or a monoline lender. Just give them a call and ask what their best rate is to lock into a fixed term. You can also look into refinancing some of your debt, rolling in some of your credit card debt, some of your higher payment debt into your mortgage at the same time. Rates right now are still incredibly low by historical standards, and if you were to refinance, although you would pay a penalty for breaking your variable rate mortgage, you might end up saving a ton in the long term. As I said, nobody really knows what's going to happen with interest rates, although it's pretty clear that the writing is on the wall. They are going to go up. We just don't know how high. It is worth noting that the last time the inflation rate was this high in 1991, prime rate was at 8.5, and right now our prime rate is at 2.45. So there is a 6% difference between our prime rate now and our prime rate then, and our inflation rate is the same. So that doesn't mean that prime is going up to 8.5, but still, it's definitely something to think about when you're trying to budget for the future. We will have updates out on these interest rate hikes and the state of Canadian real estate as this goes on. Click like and subscribe if you want to get those updates, and thanks so much for watching.